So I'm very, very excited today to have Howard Lubert with us. He is the president of the Mid-Atlantic region for Keiretsu Forum. And you've heard companies come through, they come from the Mid-Atlantic, they're being syndicated to us, and they say, I've got Howard Lubert's term sheet, participating preferred. Well, what does that all mean? So we have Howard here today to talk to us a little bit about his term sheet, how it works, and why he has certain clauses in there that he does. So Howard, thank you so much for being here today. I'm going to stop my screen share and turn the meeting over to you.
Okay, thank you, Brianna. Let me get my screen share going, and thank you all for agreeing to spend a few minutes with me. And I'm going to assume that you are seeing the screen at this point.
We do, we see it. Thank you so much.
Okay, so I've been tasked with getting through 286 slides in 20 minutes, which I was able to accomplish last week. Actually, there's only 30 slides. So we'll start with a quote of the day that I shared last week. It's interesting. We made an investment in a company out of Pittsburgh called Carmel Therapeutics, our first round over 6 years ago. This quote came unsolicited from the CEO of the company, Randy Hubble. I'll just give you 30 seconds to read that, and then we'll get going. Excuse me. I celebrated my 35th year in private equity yesterday, March 15th, marked my official 35-year birthday in the private equity and venture space. This is the first time in my 35-year history that a VC, especially with a $49 million raise, VC took the term sheet verbatim from an angel group and applied it to and accepted it for this raise. So the terms, I would like to suggest to each and every one of you that term sheets are the holy grail of investing. It is the Cliff's Notes and lets people know right up front whether or not there's a likelihood of someone going to write a check. And I found an interesting quote from Warren Buffett that I'd like to share with you there. An investor should act as though he had a lifetime decision card with just 20 punches on it. I found that kind of profound because we tell all of our members that you need to build a portfolio of 20 fully vetted and strong deals. And once you've done that, there's a better than 80% chance you'll see a 2.5x return on your investment. So I just wanted to share that with you. So we position term sheets a little bit differently than any other region in Keiretsu in North America. Effective last January, so for the last 16 or so months, if we invite a company to move into due diligence with us, it is with the understanding that we are going to dictate the terms and effectively lead the deal with our term sheet. We openly accept deal flow from all the other regions, and frankly, most of the deal flow that comes into the Mid-Atlantic region comes out of the Pacific Northwest / Rockies and Toronto. And we openly accept those deals. If they come with a due diligence report and a term sheet, we don't try to second guess them. But if we're going to ask our members to invest the effort and time to create what is, of course, a famous due diligence report, then we are going to dictate the terms to some extent in that. So in the 16-month history, we have only had 2 companies reject the concept of our leading with a participating preferred term sheet. And we'll get through the highlights of that term sheet as part of this presentation. We only want to invest in equity if we are given a choice. And with our term sheet, it is participating preferred with a 1x return, and it's an accelerated return, assuming the company is in a position to handle distributions at some point in their future. On those, we will not do convertible notes, but again, if a deal comes to us with a convertible note and we know that there's an equity priced round coming in the near future, we welcome those deals with open arms. If we are in a situation where we're going to create a bridge round for a priced round in the near future, we have standardized on the new SAFE 2, which is referred to as the post-money SAFE, and we'll talk about that as part of this as well. As I pointed out, so The original safe came out in 2013. The new one came out in 2018. Here's a quote right from the Y Combinator website. We have slightly modified one of their models so that our safe includes a valuation cap plus a discount plus most favored nation and a pro rata side letter if we decide to invest in the round alongside everyone else. So this all started with my philosophy of term sheets. Again, 35 years into this. I'm a psychologist by education. It's my position that the term sheet may very well be the single most important marketing document a company ever issues. It must attract and excite investors into writing checks. And with that philosophy, we've moved straight into the position that we have today. So how do you create investor attraction? You do it with compelling options in the term sheet that are very attractive to them, yet at the same time are fair to the founders and all of the people that came before us. And we'll cover most, if not all of these as part, with one new feature that I'll cover when we get to it in the review of the term sheet. Probably no one on the call today doesn't recognize that you can't even begin to write a term sheet until you've come to an agreement on valuation. My suggestion here is that regardless of the push and pull in getting to valuation, the right pre-money valuation is the one that will attract investors to write checks as part of the rest of the package. I remind entrepreneurs all the time that if you need this money for your company to succeed, and you're not able to attract investors to write the checks, there won't be a company. There are over 24 different ways to do valuations. Some of them are as complex as long as the day is. Here is the simplest one you will ever see, the one I've been using for about 30 years now. This is not a tried and true valuation methodology. This is a way to get the conversation about valuation open in what I would refer to as a legitimate area. And it's a very, very simple application. Here's what you need to do. Take all of the money that the company has raised to date coming into the round you're about to consider funding, including all non-dilutive funding, and divide that by the pre-money valuation, as you can see from the example on here. If the number that you get, the result is greater than 10, you're out of the ballpark. It should almost always be a single digit number and negotiate from there. And with this example, the company's asking a pre-money of $10 million. They've raised a total of just $250,000. If you divide 10 million by 250, you get a 40x. There is no way any company at the stage we're coming into, having raised just $250,000, is probably worth a 40x. But again, this is just a way to get to a way to open the door to an honest and straightforward negotiation of the valuation. So the questions you have to ask yourself, Keiretsu Forum is famous for due diligence. We're famous for a lot of things, but due diligence when the rubber meets the road is probably the number one performance issue that we deliver. So if venture capitalists and private equity professionals and funds create and impose term sheets, why shouldn't we? And that's the concept that I brought, having come out of the private equity space many, many, many years ago. So we think and execute just like VCs and private equity funds do. And I would like to suggest to you that angel investing, not just angel investing is hard work, but the work that we do on due diligence creates a significant investment in effort in exchange for a potential investment. So why not maximize that right up front? And the way we do that is right after a company has been invited to move into due diligence with us, and the team has been formed, literally 2 days or a day after the kickoff meeting takes place, our due diligence director reaches out to the company. We send them a sample of our term sheet if they haven't already seen it, and we schedule a time to go through it step by step. And we negotiate right from the front so that we know the efforts of our members in executing the due diligence will not be for naught. The goal of the term sheet, quite simply, is to create the most attractive investment opportunity possible for Keiretsu members without demotivating the entrepreneur and their team. Remember, excite and attract investors. So what I'm going to do now is just kind of highlight the 12 or 15 key items in our term sheets that do that. First and foremost, it is a participating preferred instrument. Second, that participating preferred is designed to create early return of capital should the company sign a licensing agreement or get profitable prior to any kind of a liquidity event. If the company's board votes to do distributions, we stand in line to get those distributions at an accelerated rate over everyone else. The way we structure the term sheet is everything that you see on the slides that I have here for you today. If you see anything in bold print, those are the areas that are open to negotiation. So for example, on this particular slide, 70-30 happens to be the quote unquote norm. It can be 80-20, it can be 90-10, it can be 60-40. It can't be anything lower than 60-40, and we will not allow a 100% classic VC participating term sheet where the common and all the people before us get absolutely nothing. That's a demotivating factor that we don't want to put in place. Along with the participating preferred early return of capital, we structure our term sheets around warrants. And we do this for two reasons. Number one, it's a psychological incentive to get people to write checks quicker, because the sooner you get in the deal, the greater your warrant coverage, as you can see from this example. Assume for a minute that a company is raising $3 million and each of the three tranches are equal at $1 million each. Those of us who invest in the first tranche get 30% warrant coverage, in the second 20%, in the third 10%. And again, these are negotiable. And they exercise at the exact same price that you bought your equity in the company as part of this round. The second reason we like warrants over any other option is that it is the one option that provides 100% control to the investor. You decide within the next 5 years of making your investment whether or not you want to execute these warrants. A new feature for 2021 that we added in February that is starting to gain a lot of interest and momentum is that we've added an additional warrant coverage option for all of the Keiretsu members who serve on the due diligence team. The member who leads the due diligence team and makes an investment in the company gets an extra 15% warrant coverage, and all of the members who participated on the team and invest get an extra 10% warrant coverage. You have to be an investor to take advantage of this. These are not free warrants. We recognize that liquidation and liquidity events are different because of the participating preferred language in the term sheet. So to us, a liquidation event is a negative. Our assumption is that if the company's not doing well and it actually ends up failing, there is a likelihood that there were never any distributions. We want to be first in line after the bank and anyone else that may have a position superior to our equity position. We want our 1x back, and then we want to share pari passu with anything that's left. In a liquidity event, a positive event, we want the balance of our 1x if we haven't already gotten some distributions. If there have been no distributions, no early return of capital, then we get the full 1x at this point. We try to structure the term sheets so that we have parity on the board, so that we not only have oversight and a fiduciary responsibility, but we have some control and say of the company. I would say that about 90% of the term sheets that we negotiate, we are successful in closing parity on the board. This is a perfect example of a 5-person board. We earn the right to our 2 seats as we finish funding the round. The common holders or the previous investors get the next tranche, and then the board, by simple majority vote, picks a truly independent director who is going to help the company, and that person joins the board without any outside intervention. 7 years ago in our 10-year history, we made an investment in a great company in the LED lighting space that has turned out to be a very successful family-style business. In fact, such successful that in 2019, the company dropped over $250,000 to the bottom line, and the founders decided not to do any distributions to their members. That ended up, it's an LLC, by the way, and that ended up creating phantom income for all of us that had invested in the company and created a tax position. We recognized that long ago, but not in time to catch this one lifestyle business. But since then, we have had to put right in our term sheets that this specific wording indicates that if the company that we've invested in 5 years from now has not returned at least 75% of our early return of capital, we can create a situation where they have to buy us out. We include a most favored nation clause in every one of our term sheets, just so that if someone comes along and closes the round and takes a significant position, but wants to dictate greater terms, we have the right to put our hand up and say we want the same terms. Because some companies have, in some cases accidentally, and in some cases, shall we say, less than ethically broken first close and broken escrow before they were legally entitled to do so, we now include in our term sheet a legal document that has to be executed typically by the company's law firm. If the law firm does not offer escrow services, then we work with them, or their law firm will work to identify an escrow agent who will manage the money, so that we don't have situations where the escrow gets broken before they reach first close. Fees. You heard Brianna mention that many times the entrepreneurs are paying their law firms to create their term sheets. We pay one law firm to represent every single person who invests in the round, not just Keiretsu members, because we syndicate well over 80% of all the deals that we do, and we syndicate not just to other Keiretsu chapters and regions. We currently have syndication treaties with 33 Angel Capital Association related angel groups that actively solicit opportunities for their members to invest. So we asked the company to commit to paying a $10,000 contingent fee payable and due the day they break first close. So going back to the example we used before on a $3 million raise, when that first tranche is done at $1 million, that may be the signal to break escrow. At that same time, the law firm that we had selected to represent all of the investors in the deal issues an invoice for $10,000. If for some reason we don't get to first close, there is no invoice. We also request that the company take control of their folder on the Procedure platform and convert it from an investment vehicle that we're using to a investor information rights and communication platform. And I'm pleased to announce that while we've been doing this for 10 years now, or 8 years, Procedure has never charged the companies that have transitioned over from us the $250 a year fee that we agreed on to do that. As I mentioned earlier, with the Warren Buffett quote, we recognize that we get a lot of new members who are concerned about how they're going to get to 20 fully vetted and qualified deals for their portfolio. So one of the things we've negotiated in our term sheets is we asked the company to accept 10 $10,000 investments from Keiretsu Forum members in good standing in the first tranche. More if they want to, less if they don't. But we've yet to have anyone turn us down on this clause. It's a fast and quick way to jumpstart the first 100K into a deal. and it helps those members who are looking to build their portfolio quickly by being able to spread some of their investment dollars around to more deals. We had a situation about 5 years ago where we almost ended up losing an investment portfolio company because the board was deadlocked literally for 3.5 months over an issue. And while they were deadlocked, the company was just literally sitting dead in the water. So we've added a clause to all of our term sheets that allows the chairman of the board, even if he or she had voted that caused the deadlock by being on one side, if it can't be resolved within 48 hours and the board deems it to be a critical component of the success of the company, then the chairman gets to vote again to move the thing on one way or another. God forbid we ever have a deal that ends up not doing nearly as well as they told us they were going to do, and they end up having to do a down round. If they do a down round, we are using narrow-based weighted average as the formula for calculating the down round equivalent to those of us that invested. Narrow-based weighted average is different than broad-based weighted average in that only the investors in this round participate in the adjustment. The common holders do not get adjusted. Our philosophy simply is that if the management team pricked their finger and signed this term sheet in blood and told us they were going to deliver, and for whatever reason weren't able to, there is no reason why their equity in the company should be adjusted. So why should you dictate the term sheet? Again, it's the likelihood of protecting your upside as much as possible. We believe that maximizing the value of a K4 member's investments and investing strategy is here. As I alluded to earlier, the Keiretsu brand is #1 in angel investing. Our due diligence reports virtually guarantee investments from angels, regardless of where they syndicate them to. So why shouldn't we maximize our return on investment as part of the due diligence? And by the way, it makes the funding effort easier because of the reputation of Keiretsu's due diligence and this term sheet. As I mentioned earlier, we syndicate 80% of our deals across the board, the concept of getting all of the deals funded. So in summary, very quickly, term sheets are the key to the greatest investments. Use the Keiretsu swarm intelligence and mind share to position us in the best possible positions we can by papering the deal with the best possible returns you can. And with that, I'm not sure, but if we have any time for questions, here we go.
All right, thanks, Howard.